So let's talk about how the rubber hits the road here. Like for investors that want to take this kind of step, what are some of the options, right? I mean, obviously, one option, which may be a good first step, is to take what Rodrigo said, which is kind of trim back your 60/40 portfolio to free up some capital and then allocate to a few trend and macro trading funds, right? To get some juice there on the inflation side, right? So that's kind of a simple step that I think most advisors can take to some extent. And then, we've obviously done a lot of talking recently, published papers, et cetera, indices about this return stacking concept where you actually don't need to take away exposure from your core holdings, but rather you can stack these trend and macro trading strategies directly on top of a full exposure to 60/40. So maybe,
Yeah.
Rod, you're sort of the progenitor here. Why don't you talk about that?
Yeah, so this is, by the way, Milan just added a comment here, like throw in some convexity and take advantage of that downside, maybe some upside from Newfound, and Simplify has some structured alpha. And yes, of course, the stacking returns piece was written with Corey Hofstein from Newfound. So if you go to returnstacking.com, you'll be able to download the paper. But the long and short of that is that you again, talking about behavior, right? The reason everybody sold this out is because you're dragging returns down in a decade where CTAs and global macro have done single digit. Okay, so what's the solution to this? How can we give you what you need? How can you get that behavioral need for tracking the market that you care about, and also get the sugar on top, the protection on top, where you're not going to give up on it in a decade where it does single digits? Where today, there are a number of products that have stacking embedded into their products, meaning you give them $100, you can get more than $100 of two different types of betas, bonds, equity, so 90% bond equity, 60% bonds, or an alpha and a beta, so 50% SPY and 100% equity, or the funds that we sub-advise have risk parity. Stacked on top of that is systematic global macro. So you add Simplify has some basic beta with convexity. Hofstein has and Newfound has 75% active equity, 75% active bonds. So it goes on. And then you can put them together in a way where, in the case of the report, we did 60 equities, 40 bonds, and then 30 CTA and 30 global macro. And we just did this analysis, Corey and I, for the last decade. The difference between the 60/40 and the stacked return is positive. There's a positive carry there, an annualized return about 1, but it's kind of small, right? What does that mean? Well, you got your diversification and you didn't give up on it. But then if you examine that same portfolio from 2000 to 2011, the stacking is like 500 basis points. It's a massive dispersion, right? So it's a way to think about capital efficiency using 40 Act funds that allow you to stick to it. And then maybe if we're right about inflation volatility, you get a boost and a bonus.
Yeah.
and diversification.
It's addressing the behavioral vulnerability of tracking error. And at the moment, in today's world, the tracking error is to the 60/40. Mm-hmm. That's not always the case, as we've experienced through our careers, that it's not always the US 60/40 that is the premium or paramount tracking error issue.
Oh, you couldn't talk investors into buying S&P in 2007. They wanted nothing to do with it, right?
Yeah.
So
again, it's that what is it that the end investor can actually tolerate is a very important part of the calculus that goes into what you can propose for them. And my estimation is that as we move through the next decade, we may see an attenuation of that peak tracking error being to the 60/40. Maybe not, but that would be, my thinking is I would propose that that's a probable event, but who knows? What do I know? Sorry,
well, look,
go ahead, Bob.
I just wanted to, Corey and I put these together today, actually. So here you can see it. This is the last decade, where the blue line is a 60/40 portfolio and the black line is a stacked return index, right? some benefit, some excess return, not amazing, but better than the yellow line, which is the non-levered version, right? Where you're just making room in the last decade to add those diversifiers.
Right.
But
But
if
you've
you go
actually got to
back-
take capital allocation away from
Away
the
from your-
60/40
that's
in
right.
order to add it over here. Rather, let's stack it on top. Yeah.
And by the way, I'm not opposed to that. I think it's
Yeah.
awesome, and you should do that if that's the only thing you can do. And leverage is something that you can't do. It's just you then just have to think about it in a different way. But here's the contrast, right, to the previous decade, 2000s, right? Even the non-levered index did significantly better, right? And acted as that diversifier we've been saying, and acted as a protection against bear markets. But certainly the stacked version of it did even better. So anyway, food for thought in terms of like rubber meeting hitting the road. That is how to think about this, and that might be a behavioral way of getting better at it for yourselves, your clients, your institution, whatever the case may be.
We publish an index page too for the return stacking index, and you can find it at returnstacking.live.